While you were working this week, somebody else got richer off your work. Not because they built something, not because they invented something, because you owe them. That is not a political statement. That is not a conspiracy theory. That is arithmetic. And it has been arithmetic for 2,000 years. $348 trillion. That is the total amount of debt in the world right now, confirmed by the Institute of International Finance in their February 2026 Global Debt Monitor. $348 trillion. To put that in perspective, it is more than 3 times the combined annual economic output of every country on Earth. And every single dollar of that debt belongs to someone on the receiving end, someone who collects, someone who owns, someone whose wealth grows while others work. Before we go any further, if you are new to this channel, hit subscribe right now and drop a comment below. Do you think the debt system was designed this way, or did it just evolve? I read every single comment. Now let us get into it. I want to be precise about what this video is and what it is not. This is not a video about capitalism being evil or communism being the answer. This is not political. This is structural. The research is documented, the numbers are sourced, and everything I am going to show you today, you can verify in the academic literature from Michael Hudson at the University of Missouri, Kansas City, to David Graeber's 5,000 years of documented debt history, published through Melville House, to the quarterly data tables maintained by the International Monetary Fund. Peer-reviewed, multi-source, auditable. What I'm going to show you is a pattern, not a conspiracy, a pattern. A pattern so old, so consistent, and so consistent across entirely different cultures, legal systems, and technological eras that once you see it, you cannot unsee it. 2 sides of every debt relationship, the creditor and the debtor, the few who own, the many who owe. And a system, not a conspiracy, a system that has always worked harder for the first group than for the second. Here is the framework. 3 historical episodes, 3 different civilizations, 3 different centuries, same structure. At the end, I am going to show you exactly what that structure looks like in your own financial life today. Not to frighten you, but to give you the clearest possible picture of how this machine actually works. Because understanding the machine is the first step to navigating it with any real intelligence. Sound familiar already? Good, because that recognition is the beginning. Let us start in Rome, 509 BC. The Roman Republic has just expelled its last king. The patricians, the old aristocratic families who own most of the arable land, dominate the courts, control the Senate, hold the military command structure, and monopolize the religious priesthood are in complete control. The plebeians, the farmers, the craftsmen, the artisans, the soldiers who actually fight and bleed in the Republic's wars carry all the obligations and almost none of the political power. Think about what that means for a moment. The people doing the fighting had no say in how the system worked. Here is what nobody's telling you in the standard history curriculum. The early Roman economy had a fundamental structural problem that was not an accident and was not invisible to the people living through it. Land ownership was concentrated almost entirely among patrician families. When harvests failed, and in the ancient world, harvests failed regularly because drought, disease, military raids, and the fundamental uncertainty of subsistence agriculture did not care about loan repayment schedules. A plebeian farmer had precisely 2 options. 1. Watch his family starve. 2. Borrow from a patrician creditor. Let me show you what that loan actually looked like. It was called a nexum. The word itself comes from the Latin nectare, to bind. Because that is exactly what the contract did. It bound you. A plebeian farmer would approach his patrician creditor, perform a formal ritual using bronze scales and copper weights, the ancient equivalent of signing a contract in the presence of witnesses, and pledge not just his land as collateral, but his own body, his own labor, his own freedom. If he could not repay, he did not simply lose his land. He became a nexus, a bond slave. He could be forced to work in the creditor's household or fields indefinitely, kept in chains on market days, publicly displayed in the forum so the entire city could witness the price of default. The Law of the 12 Tables, Rome's earliest codified legal document, inscribed in stone around 450 BC, specified the procedure precisely. After 30 days without payment, the creditor could seize the debtor and hold him for 60 days. During that time, on 3 consecutive market days, the debtor was paraded publicly, and the amount of the debt announced a public humiliation designed to give relatives or third parties the chance to pay. If no one did, the creditor could sell the debtor into slavery beyond the Tiber River, outside Roman jurisdiction entirely. Or if multiple creditors held claims, the law permitted them to divide what remained between them in the most literal terms the ancient world had to offer. Think about what that means. The foundational legal contract of the Roman Republic was, you borrowed our grain, you owe us your body. This is not speculation. The Roman historian Livy documents at least 14 separate debt crises during the 4th century BC alone. 14 discrete moments when plebeian farmers, crushed by interest they could not repay on harvests, destroyed by war or drought, found themselves legally bound to the men who had lent them seed. The historian Tacitus, writing centuries later, called loan interest an ingrained evil at the heart of Rome, a very frequent cause of sedition and discord. He said this more than 4 centuries after debt slavery had been formally abolished. Because the structural problem never fully went away, only the paperwork changed. And here is the part that never makes the textbooks. In 494 BC, the plebeians had finally had enough. They did not riot. They did not burn anything down. They did something more intelligent. They simply stopped. The entire plebeian class abandoned the city of Rome and marched 3 miles northeast to a hill called the Sacred Mount. This happened while Rome was actively fighting the Volsci tribe. While enemy armies were advancing toward the city gates, the plebeians stopped working the fields. They stopped supplying the army. They stopped participating in a system that extracted everything and returned almost nothing. The patricians had to negotiate. They freed some debts. They created the office of tribune of the plebs, the first government position a plebeian could hold as a direct concession to stop the withdrawal. Because the people who were owed the labor finally understood something essential. Without their labor, the system that extracted it could not function. The creditors needed the debtors far more than they had been willing to admit. Nexum was formally abolished in 326 BC by the Lex Poetelia Papiria, but debt bondage continued in modified legal forms for decades afterward. Courts could still assign insolvent debtors as bond workers to creditors. Because the law changed. The underlying architecture who owns the land, who writes the loans, who sits in judgment, did not. 2,000 years, one structure. Let us move the clock forward. 800 years later. The Western Roman Empire has collapsed. There is no central government capable of protecting ordinary people. There are no standing armies to repel raiders. There are only local lords with fortified castles and the armed retainers to staff them. You are a free peasant farmer in 10th century France. Your family has worked the same land for generations, but now that land is surrounded by a lord's territory. The lord controls the road you must use to bring your grain to market. He controls the only mill in the region where you grind your flour. He operates the only court where any legal dispute you have with your neighbor can be settled. You are, on paper, a free man. In practice, no viable path through your life, no path to market, no path to justice, no path to safety runs anywhere except through the Lord. When the harvest fails, and again, harvests fail, you borrow. Not from a distant bank, from the Lord. And the interest is not always paid in coin. It is paid in labor, in days worked on the Lord's demesne, his personal land, instead of on your own. In portions of your harvest surrendered at the gate every season. In fees paid when you marry, when you need the Lord's permission to leave the estate. When your heir inherits your plot and needs formal blessing to continue working the land you spent your lifetime clearing and improving. This is medieval serfdom, not a free choice made freely by rational actors in a fair market. A structural inevitability engineered on the foundation of who owned the land, who owned the mill, who owned the courts, and who wrote and enforced the laws. Historians from Paul Friedman at Yale to Mark Bloch, whose landmark 2-volume study of feudal society remains definitive, describe it in identical terms. Serfdom was a mechanism for extracting labor and surplus wealth from those who worked the land and redirecting it upward continuously to those who owned it. The children of serfs were born serfs. The obligation was inherited. The bondage passed from parent to child without a single new contract being signed, because none was needed. The system had already been built, and it sustained itself through law, through custom, through the simple structural reality that the alternative, leaving the Lord's territory without permission, in a period with no central government, no urban economy capable of absorbing free labor, and no protection from the next raiding party was, for most families, effectively a death sentence. By the 11th century, free tenants made up fewer than 10% of the peasant population in most of England. 90% of the agricultural workforce operated under some form of legal obligation to a lord. 90% of the labor that fed society directed upward, not through violence alone, though violence enforced it when necessary, through debt, through legal structure, through the systematic design of who could own property, who could inherit land, who could move freely, and who could not. Pause and consider something precisely. In medieval Europe, the system did not need to physically chain anyone to extract their labor. It simply ensured that the only path to survival ran through the Lord, that the alternative to obligation was starvation, and then it called the resulting arrangement natural order. That logic is not medieval. That logic is closer than you think. Now we arrive at the moment in history you actually lived through. September 15th, 2008. Lehman Brothers files for bankruptcy protection, the largest corporate bankruptcy in American history at that time. 158 years of institutional existence terminated in a single morning, as the firm's exposure to mortgage-backed securities instruments built from millions of individual home loans became impossible to conceal. What follows over the next 18 months destroys $11 trillion in American household wealth. $11 trillion. Erased from home values, retirement accounts, and savings balances, as documented by Federal Reserve and Federal Deposit Insurance Corporation data. That number deserves a moment. $11 trillion gone not from corporate balance sheets, but from the retirement accounts and home equity of ordinary American families. 8 million Americans lose their jobs. Millions of Americans lose their homes to foreclosure. The unemployment rate peaks at 10% in October 2009. In the span of roughly 3 years, the largest middle-class wealth destruction in American history since the Great Depression unfolds. Now here is the part that matters most. If you have been watching this channel for a while, you already know what is coming. Hundreds of thousands of people who follow this analysis have been tracking this exact pattern, the gap between what the system does for institutions when they fail and what it does for individuals when they fail. If this analysis is resonating with you, you belong in that conversation. Subscribe, hit the notification bell, and share this video with one person you think needs to see it. Now back to 2008. Congress authorizes $700 billion under the Troubled Asset Relief Program TARP, signed into law on October 3, 2008. The actual amount dispersed was approximately $443 billion, confirmed by the Government Accountability Office in their final TARP audit. The money flows to banks, to the insurance giant AIG, to the financial institutions whose leverage and speculation created the conditions for the crisis. Federal Reserve Chairman Ben Bernanke told the Financial Crisis Inquiry Commission that 12 of the 13 most important American financial institutions were at risk of failure within a period of a week or two. Translation: the institutions that built the products that failed were the first institutions the government moved to save. Now, let us look at what happened to the debtors. The people who held the mortgages, often on terms they did not fully understand, often sold by brokers compensated by commission regardless of whether the borrower could actually repay, often with adjustable interest rates engineered to reset upward at precisely the moment housing values began falling. In the years following 2007, approximately 7.8 million American families lost their homes to foreclosure, according to CoreLogic housing market data spanning the decade of the crisis. Under TARP, approximately $46 billion was committed across all homeowner relief programs combined. Of that, approximately $27 billion was specifically obligated to making home affordable, the core loan modification program. Let me give you the comparison that crystallizes the structure. The Troubled Asset Relief Program committed over $400 billion to the creditor side of the crisis. The Homeowner Relief Program committed $27 billion to the debtor side. That ratio did not emerge from malice. It emerged from the institutional logic of who is too big to fail, who the system's rules are designed to protect first, and whose solvency is treated as synonymous with systemic stability. And here is what nobody's telling you about the recovery that followed. When the Federal Reserve lowered interest rates to near zero and began purchasing assets through quantitative easing, injecting capital into the financial system, asset prices recovered. Stock markets recovered, real estate values recovered. But the recovery was not distributed evenly. The people who still held assets when the recovery began, those who had not lost their homes, who had not liquidated retirement accounts to survive, who had capital available to purchase distressed assets at crisis-era prices, they recovered faster and recovered more completely. The people who lost their homes, their retirement savings, and their jobs during the crisis were not positioned to participate in the asset price recovery. They had already lost the assets, or they still owed on them. Sound familiar? Because you have heard this story twice already, in Rome, in medieval France. When a debt crisis is resolved primarily from the creditor side, the architecture of that resolution distributes losses broadly across all taxpayers, while concentrating the gains of recovery where assets are concentrated. The structure does not require conspiracy. It requires only that the system follow its own institutional logic, the logic that has operated in every debt crisis in this video. The logic of who gets rescued first, who writes the rules of rescue, and whose solvency is coded as essential, not through moral failure, through institutional design, through the ancient arithmetic of creditors and debtors. If that pattern is landing, If you are starting to see the architecture across these 3 episodes, hit the like button right now. It signals to the algorithm that this analysis deserves a wider audience. And drop your answer in the comments. Which of the 3 episodes in this video surprised you most? I will read every response. Now let us bring this home, to you, to today. American households currently carry nearly $19 trillion in total debt, according to the New York Federal Reserve's Household Debt and Credit Report for the 4th quarter of 2025. That number has grown by nearly $4.6 trillion since the end of 2019, before the pandemic, before the inflation surge, before interest rates doubled. $4.6 trillion in new household obligations added in 6 years, while wages, for most Americans, grew more slowly than the cost of the debt itself. $13.2 trillion of it is mortgage debt. $1.3 trillion is credit card debt carried at interest rates that now average above 20% annually. $1.7 trillion is student loan debt. $1.7 trillion is auto loan debt. That is not debt distributed evenly across the economic spectrum. Credit card interest at 20% annually means that for every 5 years a balance is carried. The borrower has paid back the full original principal in interest alone, while the principal itself remains unchanged. Every month of that interest moves wealth directionally, from the borrower to the institution that holds the credit asset, from the person who owes to the person who collects. Globally, the picture is identical in structure, only larger in scale, $348 trillion in total global debt. The UBS Global Wealth Report finds that those with more than $1 million in assets, roughly 1.5% of all adults on Earth, control approximately 48% of all global personal wealth. The bottom 40% of adults, those with assets below $10,000, own less than 1% combined. These two statistics are not independent of each other. They are two sides of the same ledger. They have always been two sides of the same ledger. When debt accrues interest, the interest flows somewhere. It flows toward those who hold the asset side of the transaction. And those holders are not distributed evenly. They have never been distributed evenly. Not in Rome, not in medieval France, not in 2008, not today. I want to be direct about this next part. I am not a financial advisor. Nothing in this video is financial advice. But here is what the data suggests for anyone who wants to use this understanding practically rather than simply intellectually. Debt is not neutral. Debt is directional. Every debt contract you hold moves a portion of your income toward the institution that extended the credit every single month for the entire life of the contract. Understanding which side of each financial transaction you occupy is not pessimism. It is literacy. It is the same literacy that the Roman plebeians eventually acquired, the understanding that the system works the way it works for structural reasons, and that those structural reasons can be understood, navigated, and in some cases pushed back against. 3 things worth thinking about based entirely on understanding the mechanics. First, know the total cost of every obligation you carry. Not the monthly payment, the total cost over the full life of the contract, including interest. The calculation is simple once you run it. For most consumer debt, it is striking. Most people who carry revolving credit card balances have never calculated what those balances have cost them in total, not just monthly. That knowledge alone changes decisions. Second, distinguish between debt that builds an asset and debt that finances consumption. A mortgage on a property that appreciates is a structurally different instrument than revolving credit at 22% annual interest. The mortgage finances an asset whose value may grow. The consumer debt finances something already consumed. They produce different outcomes over time, and their directional impact on your position in the system differs meaningfully. Third, understand that the system rewards the creditor side. In Rome, the patricians were the lenders. In medieval Europe, the lords were the lenders and owned the infrastructure. In 2008, the financial institutions were the lenders. In each episode, when crisis came, the system's recovery architecture prioritized creditor solvency. Understanding that incentive structure, not to rage against it, but to see it clearly, is the basis of making more deliberate choices about which side of which transactions you want to occupy over time. In 326 BC, a young Roman plebeian named Gaius Publilius entered Nexum bondage as guarantor for his father's debt. His story, documented by the historian Livy, was the specific case that finally forced the Roman Senate to act on the Lex Poetilia Papiria and formally abolish the Nexum contract. Because one story, told clearly enough in public, made an abstract structural system suddenly human, suddenly visible, suddenly real enough that the people inside it could no longer pretend it was natural. The debt pyramid is not hidden. Its numbers are published quarterly by the International Monetary Fund, the Federal Reserve, and the Institute of International Finance. What is rare is the habit of reading the whole ledger, both sides, understanding where the interest flows, who designed that flow, and why the design has remained remarkably stable across 25 centuries of otherwise radical change. That is what this kind of understanding is for, not to produce despair, to produce clarity. And clarity is where better decisions begin. If this video gave you that clarity, subscribe to this channel. Every week, we bring you the economic and historical patterns that explain how the world actually works, not how we were taught it works. The understanding is the beginning. I will see you in the next one.